Good evening, everyone. If I have to summarize budget in one line, it was the shortest ever budget speech by Finance Minister in her 4-year tenure, but laid the longest roadmap to position India in 2047. As Gaurav mentioned, this budget can be compared with a Janus, the Roman god. Janus is the Roman god with two faces, one face representing war, creating terror, another face representing peace, creating confidence. Now, for debt market, this budget has turned out to be quite destabilizing. Gilt prices have fallen, yields have risen. For equity market, it's the other way around. Markets have gone up and celebrated this budget. Why did the same budget look so differently to both the debt and equity markets? We believe this is based on the understanding of the budget. This budget has estimated revenues on a very, very conservative basis. For example, divestment receipt in FY22 and 23 put together is estimated at 1,43,000 crore. You add market value estimate of various proposed divestment, LIC is likely to fetch 1 lakh crore to government. BPCL can fetch between 60,000 crore to 90,000 crore. Neelachal Ispat has already gone to Tata's at 10,000 crore plus. The Container Corporation, Shipping Corporation, IDBI Bank put together can give another 50, 60, 70,000 crore. So clearly, if all this divestment happen as proposed, then divestment receipt is underestimated. The small savings collection was 5,91,000, is likely to be 5,91,000 crore in FY22. The government is estimating a drop of 1,66,000 crore in the same. Now, this again looks too much. Probably small savings will continue in FY23 at the same level as FY22. That means there is underestimation of maybe 1,50,000 crore. The curious case is related to tax collection. In the first 9 months of FY22, that is April 21 to December 21, the government's net tax collection is about 14.7 trillion rupee. The last quarter, we can generate about 5 trillion rupee taxes. That means we should be roughly at about 20 trillion rupee taxes. But the revised estimate for full 12 months represents only 17.6 trillion rupee estimate. Now, will taxes fall in next 3 months from 5 trillion rupee? Answer is unlikely. And the beauty is that even for next year, we are assuming tax collection of about 19.3 trillion, when this year itself we are likely to cross 20 trillion. I was in panel discussion with Rakesh Jhunjhunwala in CNBC, where he mentioned that in his opinion, 3 to 4 lakh crore of revenue on taxation side is underestimated. RBI dividend this year was about 1,01,000 crore. Next year, it is estimated at 74,000 crore. This is despite the fact that RBI balance sheet has expanded this year by a reasonable margin. So equity market believes that government has very, very conservatively estimated its revenues. Next year, the budgeted fiscal deficit could be lower. The government spending could be higher, and hence there will be better growth. The debt market, on the other hand, is worried that whenever government does surplus, it ends up using them in clearing past liability. In FY19, there was surplus. Government used that to take off Food Corporation liability on their balance sheet. off budget item became on budget. FY22, there is some surplus. Government has taken over Air India's liability on its balance sheet as Air India is divested. So debt market is worried that government will definitely earn more revenue than estimated, but those revenues will be used to clear off something else, and the borrowing program will not be changed. This year, our borrowing program will be roughly about 7,76,000 crore on a net basis. Next year, FY23, it is expected to touch 11,18,000 crore. This is a fairly large number, and current debt market does not have capacity to absorb this. The market was also expecting that there will be a roadmap to bond indices inclusion. If India becomes part of global bond indices, we will get between 15 to 30 billion dollars. That would have taken away some of this massive borrowing program. But in absence of any clarity on the same in the budget, debt market has assumed the worst. Bond prices have come down, yields have gone up, and the same thing in equity market has been treated positively, as they believe government will spend money to build or to create investments. Now, this explains the Janus nature of the budget. But as I mentioned, in this shortest ever budget speech, Finance Minister has laid the foundation for a long-term centenary year kind of positioning. What is this budget trying to do? There is an English proverb which says that you give a fish to a man, he will survive for a day. You teach him fishing, he will survive for life. Now, in FY21, when pandemic hit us, we had no option but to give fish to people. It was a question of survival. India increased subsidy burden from 2.5 lakh crore to 7 lakh crore, so that 80 crore Indians could be provided free food grains. Now, you can't continue this forever. At some point of time, you have to reverse this. And this is the budget which is transiting from giving fish to a person to teaching him fishing so that he can survive for life on his own. How is government trying to do? How is government trying to achieve that? Well, it's the standard old mantra of spending money on investments, investments creating demand, demand creating consumption, and that creating further investment. The government on budget estimate of FY22 is increasing capex by 35%, but on a like-to-like basis, it is increasing capital expenditure by 10%. Government is focused on all the three things: wise agriculture, manufacturing, and services to encourage growth. In agriculture, government is talking about chemical-free farming, organic farming, growing oilseeds in India to replace imports, encouraging millets positioning as a health brand, focusing on agriculture exports, river linking. This year, India's agriculture exports will cross $50 billion for the first time. $50 billion looks a good number, but a country like Netherlands exports $80 billion of agriculture goods. We have a long way to reach to Netherlands level, but something is better than nothing. On manufacturing, India remains way behind countries like US, China, Japan, Korea. This is primarily happening because of the fact that Our private companies do not participate in development of military technology. Internet was creation of military technology. Many of the products which we are using in day-to-day life are thanks to military inventions. Now, government has opened up DRDO to set up joint ventures with Indian companies. It has also mandated 68% of defense spending to be spent on local items. Both these things will make Indian manufacturing competitive. The other thing which is happening on manufacturing is PLI scheme. It's a game changer along with other steps. And government is encouraging PLI in renewable energy, in solar panel. The focus on manufacturing is best illustrated by India's mobile handset sector. In FY14, we had 3 or 4 mobile factories manufacturing headsets. We were second largest consumer of mobile phones in the world, but they were mainly supported by imports. In FY15, our mobile handset manufacturing value fell to 19,000 crore. Our imports were skyrocketing and local manufacturing was falling. The government then took several steps to restore balance. There was 100% FDI, single window clearance, automatic approvals, red carpet treatment. There was cut on taxation to 15% for new manufacturing firms. There was incentivization through phased manufacturing program, electronic clusters, through import duty on handsets, and finally production-linked incentive schemes which give money for people to set up their manufacturing base in India. Fast forward to 2021, production value has increased 12 times from 19,000 crore to 2,20,000 crore. This year will be even more. From 12th largest manufacturer, we have become second largest manufacturer, overtaking South Korea and Vietnam. From importing $8 billion worth of mobile handsets, we are exporting $5 billion worth of mobile handsets in FY22. The world's single location largest mobile handset factory is now operated by Samsung in Noida. They are making 6 crore phones annually, and it is expected to double the capacity to 12 crore phones, as Samsung has announced investments of $50 billion in India. We were assembler of phones in 2014. Now we are increasing value add from 15 to 20% value add. We are moving towards 30 to 40% value add over next couple of years. Mobile handsets shows the template of how India can improve its manufacturing, how it can increase market share. And today, this budget is again laying the roadmap on which Indian entrepreneurs can become part of the global supply chain. The focus is also on servicing service industry and startups and digital and fintech. Our listed companies put together, Tata, Birla, Ambani, Adani, and some government companies, they make an investment of $75 billion a year. This is approximate number. This year, private equity and venture capital flow is likely to touch $70 billion, almost equivalent to what our Tatas, Birlas, Ambanis, and Adanis are investing. This is the importance of Startup India, Digital India, PVC funds. Government is taking all steps to ensure that it continues to increase. The launch of CBDC will create a frictionless payment system. Digital bank in 75 districts also will help financial inclusion. The post office going to core banking solution also will improve financial inclusion and hopefully move Indian savings from real estate and gold to financial assets like bank deposits, mutual funds, insurance policies. Overall, this budget is a bet that government can spend money on investments. And with that, they will create an ecosystem where Indian entrepreneurs, startups will create jobs, will create demand, and will spur consumption. Devil is always in the execution. While revenue has been underestimated to maybe between 3 to 5 lakh crore, some expenditure also has been underestimated, whether Manrega allocation, whether fertilizer subsidy, there could be maybe 30 to 40,000 crore increase over there. But that's part and parcel of normal game. Overall budget number looks fairly conservative, fairly achievable. And we hope and pray that our real numbers end up exceeding budget by a margin. Now convert this into equity and fixed income. The cardinal principle says that if actual events turns out to be better than what is priced by the market, markets will rise. If actual event turns out to be worse than what is priced by the market, markets will fall. Now let's figure out what is discounted by the market right now as we speak. Number one, market is assuming that Omicron will have limited impact on economic activities. This is turning out to be true as cases have dropped in Mumbai, Delhi, and also in India. If there's no new variant and we all go back to our regular life where I can come and present this in person, I think markets will continue to rise. Number two, today there is a kabaddi match going on between FPIs and DIIs. FPIs are selling in India because this is where they have made a lot of profit. This is where their portfolios have become overweight India by a margin. And they need to take some money home because of rising US interest rates. Now, FPI selling could be without price limit like March, April, May 2020. In that event, markets will correct sharply, but bounce back also will be equally swift. Or FPIs could be selling in a calibrated manner with price limits like they have done in October 21 to Jan 22. The selling by FPIs in secondary market in October 21 to Jan 22 is as intense as it was in March, April, May 20. The only difference is that in March 20, they were giving without limit orders. Today, they are giving with limit orders. If you believe that FPI selling will be very aggressive without price limit, there will be correction. If they are calibrated, then they may keep market in range-bound fashion. And if they stop selling or turn buyers, markets will rise. Our view is that in the first half, FPIs might be a net seller, but eventually they will be buyer. Their selling intensity will start reducing as we speak, and that will support the market. Yesterday, FPI selling did come down. And also today, it looks like that FPI will be a net buyer. The third thing which market is discounting is that corporate India is on its way to deliver profits. Nifty 50 companies' profits will touch 7 lakh crore in FY23. This will give earning per share for Nifty 50 companies of 875 rupees. The December quarters have more or less come as per expectations to touch 875 or 7 lakh crore of profit for Nifty 50 companies in FY23. As long as we are on that trajectory, markets will rise. If the trajectory instead of 875 Nifty EPS becomes, let's say, 825, markets will fall. If it becomes 900, markets will rise a little bit more. Our feeling is that earnings are more or less likely to come between 850 to 875 rupees for FY23. Now put all these things together. Equity markets have discounted Omicron. They are expecting normal economic activities. They are expecting earnings trajectory for next year at 875 rupee. And they are expecting that FPI and DII Kabaddi match will figure out what is the short-term level of the market. If FPIs are selling aggressively, we'll go to 16,500 level. If DIIs are buying aggressively, we'll go to 18,500 level. If they are matching each other, we will be at maybe 17,500 level. This is what equity markets are discounting. And if actual events turns out to be better, then markets will rise. If actual event turns out to be worse, then markets will fall. What is the biggest risk to the market? Oil prices, yes, they are rising. It will impact part of the market. But if rising oil prices are resulting into rising US interest rates and also resulting into rising interest rates in India, then there will be more impact in India. We believe markets have discounted $100 of oil. If oil remains around that level, it should be well within the discounting of market. Market has also discounted 7% 10-year yield. If 10-year yield remains around that, that's priced in. Market has also discounted about 7 to 8 times rate hikes in US. That's also discounted. Any of this variable higher than this will pull market down. Lower than this will push market up. What should we do as an investor? This is fair value market. It is already trading at 20 times FY23. It is little over fair value, but I'm just rounding off the numbers. If you are overweight in equity, this is good time to book profit and become equal weight. If you are equal weight in equity, please continue your SIP. And if you are underweight in equity, this is time to do systematic transfer for next 6 months over 12 installments to get invested into the market so that you are equal weight to equity. At what level one should become overweight equity? Well, any valuation below historical average becomes overweight. Our historical average valuation is about 18 times. 18 times 875, you will get roughly rounded off 16,000 Nifty. So below 16,000 Nifty, for this quarter, you could be overweight equity. 16,000 to 18,000, you could be equal weight equity. And above 18,500, you can book profit. Obviously, these ranges will change as we move towards next year. Between large, mid, small and mid caps have done exceptionally well compared to large cap over last 2 years. Now, this is time to be little bit overweight large cap, little bit underweight mid cap, and little bit an equal weight small cap. We think now returns of large, mid, and small will be almost similar. What kind of sector we should look at? Well, you should look at sectors like capital goods and engineering. They are benefiting from government's increased investment spending, also exports market, and also the revival of private sector demand in India. We are also bullish pharma sector. They have underperformed market for last 1 year. They are now getting approvals from US FDA and valuations have become reasonable. We also are bullish on home improvement, real estate, and construction. Though budget has not provided any particular incentive for that sector, a lot is happening on the ground where we believe these sectors will have better volume, higher margin, and hence outperformance over market. Coming to fixed income, rates have risen over last 1 year from 6% towards 7% as government gave a very, very large borrowing program. debt market is ignoring underestimation or conservative estimate of revenue, as they are worried that this revenues will be used for something else and borrowing program will continue unabated. There was a time few years ago where 25,000 crore was a monthly borrowing target. Now we are borrowing 25,000 crore a week. There is almost fourfold increase in the borrowing program. This has put pressure on interest rates. Roadmap to bond inclusion has not been announced, and RBI has not intervened in the market. It's a paradox kind of situation because banking system has 5 lakh crore plus liquidity. Government has 5,50,000 crore liquidity. 10,50,000 crore cash is lying in the system between government and bank, and debt market is worried about borrowing program of 11,18,000 crore. Can this liquidity get invested in GSEC? Answer is yes. Today they are getting deployed at 4%. They should be happy to get 7% on 10-year yield, but it is still waiting on the sideline, not getting invested in government securities. Clearly, it requires RBI's intervention, and it requires some help from US Fed. In current circumstances, we believe as an investor, you are better off investing in short-term bond fund, corporate bond fund, and PSU debt fund. These are the funds where even if interest rate goes up, it will have limited impact because of low duration. If you are willing to take some volatility, dynamic bond fund can be looked at. These funds have given barely positive return over last 1 year because interest rates went from 6 to 7. We believe there will be near-term volatility as 7 will go up and down. But over a period of time, over next 2-3 years, interest rates will decline as central bank monitors inflation and controls it. In that scenario, dynamic bond fund will be in a better position to provide return. So for a conservative debt investor, short-term bond fund, corporate bond fund, PSU debt fund will be more appropriate. Someone willing to take risk can look at dynamic bond fund. There are many investors who are today concerned about lower interest rates on debt products, whether it's bank fixed deposits, whether it's bonds, debentures, whether it's company fixed deposits, whether it's debt mutual funds. The returns are all around mid-single digit and many a times after tax, low single digit. We will recommend them to look at hybrid products. You have a range of hybrid products available to you. Debt hybrid scheme has allocation of 10 to 25% in equity. Equity saving schemes have allocation between 25 to 50% in equity. Balance fund has 65 to 80% in equity. Between these three funds, you can build a portfolio whereby your risk will be a little higher than debt fund, but it will be compensated by higher returns. If you want to outperform inflation, this products will be one of the better bet. This is how broadly we see equity and debt market. Equity is rejoicing a bold budget, which is trying to spend on investment so that virtuous job cycle, consumption cycle, and demand cycle can be created. The debt market is worried about the borrowing program, and hence yields have formed up. At the end of the day, a lot will depend upon how RBI manages yields. And on 9th February, there is credit policy that will tell us the roadmap. Remain invested in the market, use correction as an opportunity to add equity, and stay at the short to medium end of the maturities or duration curve to protect yourself against rising interest rates. Thank you, Gaurav Bhai.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.